Exercise 4-20, we're going to journalize the closing entries from the adjusted trial balance. So earlier in the quarter, we learned that the accounting equation is assets equals liabilities equals owner's equity, also known as capital. And we learned that there's four things that affect capital: revenue, expense, withdrawals, and investments, also known as owner contributions. And we kept track of three of these in separate accounts. Revenues are in a separate account, expenses have separate accounts, and there's a separate account for withdrawals. Investments and owner contributions went directly into capital. So it turns out that assets, liabilities, and owner's equity are the permanent accounts, and these three accounts, revenue, expense, and withdrawals, are just temporary accounts. A temporary account is one that's going to be closed at the end of the year, and then it's going to be closed into capital. In other words, we're going to close out the revenue accounts, and they're going to move into the capital account, and they will increase capital. We will close out our expense accounts, move them into the capital account, and they decrease the capital account. And withdrawals will also be closed out, and they will decrease capital. So in this problem, what we're going to do is we're going to close out revenues, expenses, and draws, and then see what our new capital amount is going to be at the end of the accounting period. So the adjusted trial balance of Smith Sign Company follows. So here's our adjusted trial balance. So this is just part of the worksheet. And this is the worksheet that shows the adjusted trial balances. So these are the balances after our adjustments. And we can scroll up and down. So let's see what else it says. Assume Smith Sign Company has a January 31 year end. So it's January 31, as you can see right here. So it's the end of their year. So we're going to close out these temporary accounts, revenues, expenses, and draws, and move them into capital. And then we will calculate how much net income or net loss the company had. So first, we're going to close out our revenue accounts. So we need to scroll down to find the revenue account. Remember, revenues and expenses are at the bottom. And it looks like our service revenue account is $17,600. So notice these are debit and credit columns. Let's see if I can make this bigger. I don't think I can. So we've got debit and credit columns. And of course, revenues are credits. They have a normal balance of credits. So we need to close out this service revenue account. So closing account means to give it a balance of 0. So how do we close this account if it has a credit balance of $17,600? We need to debit it. So I'm going to debit service revenue. So when we're closing revenues and expenses, we're going to close them out to an account called income summary. What this account does is it summarizes income, in other words, net income. So each transaction needs a debit and a matching credit. So the credit for income summary is going to be $17,600. And the explanation is we close the revenue accounts. Now the next step, we're going to close out the expense accounts. So let's find our first expense. We're going to scroll down, and here's our first expense. $3,800 salaries expense. Notice this is a debit. Expenses have debit balances. So how do we close out a debit balance? We're going to put it in as a credit. So I'm going to credit salaries expense $3,800. And the reason I'm skipping the first line is the first line has to be the debit. We don't know what the amount is. So let's close out salaries expense. And remember that what I said up here when we close out the revenue is we close it out to an account called income summary. So we close out expenses to income summary also. But we don't know the debit amount until we close out all the expenses. So our next expense is rent expense. We're going to close that out, $1,500. And I'm putting it on the credit side because it normally An expense normally has a debit balance, so to close it out, you have to put it on the opposite side. Rent expense is being closed. Next, we have depreciation expense, $400. Then we have $200 supply expense. And then we have $700 utilities expense. So now what I need to do is I need to add these up. 3,800 plus 1,500 plus 400, 200, and 700. That gives us 6,600. And this step is closing expenses. Now our next step is to close the income summary account. So to do this, it's easiest if you get a piece of scratch paper and draw a T account for income summary. And I can't really do a piece of scratch paper for a video, but I can do Excel. So I've got an income summary T account. And there is no plus and minus side for income summary. It is a temporary account with no pluses or minuses. So I'm going to scroll up and I'm going to find the first time we affected income summary, which was right here. So we closed out 17,600. So I need to post this to my T account. So notice it's 17,600, and these are revenues, by the way. 17,600. So I am posting it on the right side. And it helps if you label it. So here's my label, just to remind me that those are revenues. Then I'm going to go back to the next time we debited or credited income summary. And right here, we got 6,600 income summary on the left side, the debit side. And those represent expenses. So we got 6,600. I'll put that in red to kind of show you that those are expenses. Green is the revenue. And then I would like to label those just to remind us what is what. So getting back to our instructions, it says we need to close the expense account. So to close it, we have to know what the balance is. So to do the balance, we just need to take 17,000, the larger number, 17,600, and subtract the smaller. And since I'm in Excel, I'll just do a formula to do that for us. Equals this minus this. Voila. So we've got $11,000. So what does that $11,000 represent, by the way? Well, revenues are greater than expenses. And so what do you get when you subtract expenses from revenues? Revenue minus expense gives us net income. So that represents net income. Now we need to close this account. So how do we close an account? Well, let me write balance here. So that reminds us that this is the balance. So how do we close out an account that is a balance or has a balance of 11,000? We're going to put 11,000 on the opposite side. And I am just going to, let's just pick a random color. So we are closing it. So this 11,000 on the left side, the debit side, is how we close income summary. So if we want to label that also, the $11,000 closing, here we go. So this is how we close the income summary, 11,000 on the the left side. So now I'm going to go back to my T account, or to my journal, scroll down, and I'm going to put income summary, 11,000 on the left side. Again, why did I do that? Because we had a balance on the right side of 11,000, and we have to close this account out because it's going to go into capital instead. So how do I close out something with $11,000 credit balance? You need to debit it. And remember, this $11,000 represents net income. So what does net income, what account does net income affect? Well, net income is going to increase capital. So how do I know that I have to credit capital? Two reasons. Well, if this is right, that we debited the $11,000, then the other account has to be credited to make the transaction balance. The other way you know that capital is going to be credited is, first of all, we have to remember what was the $11,000. What did it represent? It represents net income. So what does net income do to capital? Does it decrease capital or increase capital? It increases capital. So that's another reason why we are going to credit capital. To close income summary, we close it to capital. And so the way I screwed up is I put a decimal instead of a comma. So I usually just leave out the commas because it's just another chance for error, but sometimes I like to type them in there so it's easier for you guys to read when you're watching the video. There we go. And then the last step is we need to close withdrawals. So we've already closed revenues. We close those to income summary. Then we close expenses. We close those to income summary. Then we close income summary to capital. And now we have to close withdrawals to capital. So all three of these eventually get closed to capital. So let's find our withdrawals account, and it's right here. So how do we close an account with a $1,000 debit? Well, you have to credit it. And what's the account that it gets closed to? It gets closed to capital. So some of you might be saying, well, how do you know that we should debit capital? Well, there's two ways. If we close withdrawals with a credit, then the other account has to be a debit. The other reason we know it has to be a debit is because what do withdrawals do to capital? Do they increase capital or they decrease capital? They decrease capital, and capital decreases on the left side. So that's another reason we know that we have to debit capital. So this is we close withdrawals. And now they're going to ask us, we can close this window. Smith had a net income or net loss. Well, there's a couple ways you know that they have a net income. Just scroll down here to the revenues and expenses. This revenue is obviously greater than these expenses, so that's one reason we know we have a net income. We also know we have a net income because the income summary summarizes it. So we have revenues on the right side, expenses on the left side. So now we can neatly take the revenues, subtract the expenses, gives us $11,000 net income. So Smith had a net income of $11,000. We know this because revenues exceeded expenses by this amount, and this was the balance in the income summary account. So let's go back to the income summary account. So here is the balance. So the $11,000 in income summary for the balance represents net income, revenues minus expenses. And that's it.